my time, think it's my year.
Yes, it's a bull market, everybody. Good morning. I've got the bull market shirt on. We're excited. We're all in a good mood here on the morning show on Stock Market TV. A, because bull market. B, because we appear to be prescient. We can see the future, or maybe see the future. We'll talk about that in a little bit. We got a lot going on today. Tommy Lackey is our guest. He's an old friend of mine. He's a CMT. He looks at a lot of relative strength. He's brought a lot of great charts for us. So he'll join us at 9. We'll have the one and only Alfonso coming on at around 9:15, 9:20, and then Sean McLaughlin will join us at the end of the show, talk about some options, and I'm sure the Buffalo Bills. So with that being said, you know what to do. Hit that thumbs up for me, please, and thank you. Let's bring on Steve and Pat.
Good morning.
Good morning.
Hey guys.
It's a bull
Everyone's
market
got
party.
their bull market shirts on.
Yeah, look at us. Hey, we look good this morning. It must be a bull market.
Yeah, I don't know if you heard.
I woke up at like 5 a.m. to beeping. It sounds like a fire alarm is going off in my office because we lost power in the middle of the night. I have a power backup. Once it gets low and starts it's like counting down, it beeps, and then it beeps faster and faster and faster. And I don't know how to turn it off. So from like 5 to 6 a.m., this thing just beeped, and that was my alarm this morning. But we got power back, so.
I like it.
Good. Well, we're glad to have you, Steve.
And it's brighter in here than ever.
Oh, it's
There you
bright.
go. Your lighting's perfect, Steve.
We can see you. Everything is great.
I want to say this is some production. The video, the lighting, everything it looks really
nothing to complain about today. We're all in a good mood. Should we do state of the markets? We got a lot to state about the markets.
Yeah, I mean, I have one chart today, but it's an important one. Let's hit it.
All right.
I know which one.
What is this one chart? Pray tell.
This is like the holy trinity of risk. Okay. It's home builders, it's semiconductors, and then it's a little broker dealers mixed in too. So you have a group from discretionary, you have a group from tech, and you have a group from financials. I don't know if you had to pick the most risk on or most offensive, all three of these have a very high degree of pro-cyclicality, right? Which is bull market stuff, economy stocks, you could call them. I don't know if you could find three groups that are more risk on than these. I think it's just important to take a step back and acknowledge the fact that they have all cleared overhead supply and are trading at new all-time highs. These are the leaders. They've been leaders, all three of these groups. I know you're probably thinking like broker dealers look that good. Yeah. New all-time highs. So I guess the overriding theme here is that it's definitely not bearish. This speaks to an overwhelming appetite for risk. This is evidence of investors positioning or embracing more and more risk as opposed to positioning defensively. These groups leading and being the first ones back at new all-time highs. What do you think?
I would completely agree. I mean, very,
Hard to
very
argue.
economically sensitive areas of the market. And yeah, pretty bullish message from them.
What else could be like in this basket? What are some other industry groups? Transports?
I think could you group regional banks in there?
Yes. Yeah.
I mean, I know they're not acting nearly as bullish as these guys, but
it's also that's become a special situation group this year.
Yeah.
Right?
Yeah.
Banks
yeah, totally.
not acting the way we are used to banks acting in bull markets. I would say banks.
Other than that, though,
I mean,
metals.
maybe industrials, but that's kind of with the home builders thing.
So if you were going to play devil's advocate and Pat, you're playing devil's advocate. We're having a bull bear.
Okay. All right.
And
I'll play devil's advocate.
You have to argue for risk off.
Okay.
What charts or ratios or intermarket evidence do you point to first?
Ooh. To make the bear case?
Yeah.
Ooh. I mean,
Can you just point to like RSI and say how?
I would say maybe the dollar.
No, I'm talking about specifically risk off or defensive information, right? I guess the point I'm trying to make is there's not much of it. Staples, utilities, the defensive groups, new relative lows. Leaders keep leading, right? It's high beta over low vol. It's discretionary over staples, right? All the risk on stuff. Cryptos are mooning while we're sleeping.
Couldn't you just
on stuff is working, and the
you
risk
just point to RSI and say everything is overbought?
I mean, that's not the debate I'm trying to have.
Okay, fine. Then I don't know. The answer is I don't know. I don't know what charts I would find. I would.
Would you look at something like copper?
I mean, I would say maybe the dollar, and if that thing, has a little bullish momentum divergence and starts to work higher, I'd say that's probably one of the bigger threats. Obviously, rates too, like, we kind of broke down yesterday, but if that like scooping scores, that would be a bad one for the market.
I don't know.
I think
maybe the Magnificent Seven. They're not playing ball right now, really. So
there you go. Okay, good.
I don't know.
I would say to you, they're more quality and defensive than you think.
Well, they're sort of everything, but they're risk on when they want to be, risk off when they want to be. It just depends on the mood of the day. But,
where were we having that conversation? They get to be growth, they get to be value, they get to be quality.
Yeah, they're everything.
They're in every index.
It's just ironic if you look at just like the NASDAQ over the last month, and then just say like who are the worst performers. It's Google, it's NVIDIA, right? It's like,
we do so much ratio analysis, and I learned this from a lot of excellent technicians over the years. Patrick, you probably know exactly what I'm talking about. We had a great conversation with Mark Newton about it on the show a couple months ago. You want to stay away from, I got a sneeze coming. You want to stay away from the cap weighted indexes when you're doing ratio analysis, right? Because a lot of these indexes, and look at them. If you're putting, MTUM, right, the momentum index, in a relative ratio against the S&P 500, go look at the components, see what's driving it. A lot of times these things are just, really top heavy. They're driven by a handful of stocks or weightings. You want to equal weight that, right, to get the information that you really want. You don't want to look at something like XLK SPY and say, oh, tech stocks are leading. Maybe 3 or 4 tech stocks are leading. And that's why that ratio is moving higher. Look at equal weight tech versus SPY, right? And then make that call. Does that make sense? From an information standpoint, the cap weighted stuff could fool you.
that's a really good point. I hadn't thought about that one actually in a while. So glad you brought it up.
So, short state of the markets today. You got anything, Pat?
I mean, you got the all-time high in the Dow. NASDAQ's getting awfully close. My question to you is, do you think, first of all, do you think the breakout sticks? But do you think sentiment can sustain itself? Because it seems like the bulls are getting awfully excited here.
Yeah.
And it's just, rightfully so, right? We just recovered from the worst bear market outside of COVID since 2008. But do you think we can sustain this breakout without a failed breakout? Because I've been saying for months, like if we do get back to the all-time highs, there's no way they're going to make it easy and just break out and then go. But here we are.
If we have a home builders chart, I think this would make a really good point. It depends on the chart, right? Like some of them already false started, hooked lower, and then reclaim those highs again. I'm thinking of home builders, something like ITB, right?
Right.
We saw it in, I think, one of the semiconductor indexes where like kind of went, XHB is too clean. ITB would show it. Sorry.
Like what if 2024 starts off with just a failed breakout and we just bam sell off?
Industrials, I think, is another good example. right? They went back in August, failed, and now going again. Let's get an XLI chart up here.
Almost building that like handle kind of thing.
But then there's others. Like I look at that Magnificent Seven equal weight index. It's just like running into that supply zone more or less for the first time. Maybe there's a false start or two before that eventual upside resolution. I think the answer is different depending on the chart of the group. How about financials, though? Highest level since April of 2022.
Yeah, you were all over the financials yesterday.
What happened? Oh, never mind.
Somebody in our chat here just brought up regional banks, and man, they're entering that volume pocket, right? You know, that massive move down in March really happened over just a few days, and that created a huge volume pocket, and we're just entering that now.
A lot of them look like this Key Corp chart. If we have the Key Corp chart.
Oh, there you go.
Throw that up.
Perfect illustration.
And dude, these things again today, I know the market hasn't opened yet, but this one is up another like 3%.
Oh, yeah. I mean, the KRE is up 3% pre-market.
I can't believe you got me thinking about buying stocks like this right now.
I bought more of this yesterday before the Fed meeting. It was so tightly coiled and just looking so ready to go. And now we're in. But
honestly, like I share Spencer's sentiment. Like I look at some of these, I'm like, really? Am I about to buy a bank here? I mean, this is boring stock ever most of the time. But I think they have the juice right now.
Don't let your biases fool you. These charts are ripe. Look at this. Look at this gap fill move. And a lot of them, Pat, like you're saying, and even the indexes a little bit themselves, like KREs and KBEs, but a lot of charts like this, just now getting back into these volume pockets or these gaps from March. Some of them also have gaps like this that run back several years. But there could be some wild moves here. This gap probably gets filled very quickly.
Yeah, and Steve, we were talking yesterday that there are a lot of charts with these 2020 gaps, like gaps from 2022. I'm sorry, gaps from 2022 that they're just starting to enter. A lot of individual names have that look to them, whether they miss an earnings report and then gap down last year or what. A lot of them have those on the chart, so be on the lookout for those.
And this is part of the bond trade right now too. Like cryptos have been ripping as rates have come off more than 1% now, but we're below 4% in the 10-year.
Isn't that amazing? 1% drop over a month in the 10-year.
I think this is one of the biggest moves of the year. So really big plunge yesterday in rates. But anyway, crypto, these ARKI stocks, real estate. Look at REITs off the October lows. And then look at what yields have done off of their fall highs, I think October highs, right? Yields have come down in a big way, and all of these yield-sensitive stocks have really ripped. The banks are no different. Banks are part of that same theme and same conversation, which is not the traditional relationship there, right?
Right. I got one for you. So you know how when crude oil went negative in 2020, that was kind of this moment where everyone threw out. It was a capitulation moment for energy, right? Mm-hmm. Everyone just, completely to hell with it. Do you think, and then of course you have a ridiculous uptrend after that. Do you think like financials and utilities and some of these sectors that got thrown out because of rates, mm-hmm. if rates continue lower, do you think those could see a similar kind of, I mean, we're kind of already seeing it, but do you think it could be as pronounced as energy was?
Like, was this year kind of like a capitulatory low?
Yeah, for financials and utilities.
Yeah, I think so, because and also, fundamentally, these banks over and over and over again, when they get down to a certain like book value, basically when they start trading at book, it tends to be just time and time again the right time to buy these things. It's worked so well over the years, and they're cheap right now. Some more than others. The money center banks, the big guys, kind of held their value or didn't see like their valuations get. trimmed or haircut as much as some of these regionals. Some of these regionals, you could have bought them for below book. And that's as good as it gets for the banks, especially when then you look to the charts and pair that with these nice reversal patterns. Right?
Yeah.
Something for everybody to like in the banks right now. And then you look at the broader sector, right? We just talked about in the last 15 minutes, new all-time highs for broker-dealers. Financials trading at their highest level since April of 2022. We talk about insurance stocks on here all the time. Why wouldn't the banks participate?
What's going on with insurance too? Why do you think that group is leading?
The answer to that, Steve, is some unknown thing, right? That's the answer.
Some unknown thing about
there's some unknown thing that no one's going to see coming. That's
yeah,
it.
I don't know.
What? Why wouldn't they? Oh, because there's some crazy, black swan risk like on the horizon.
Or bank blow, contagion, bank runs.
Yeah.
California bank blowups. Pat, what's
But where to happen would happen here?
You don't know until you know. Wait, to answer Pat's question about I don't know, Pat, about insurance. We've been talking about it for months. It seems like.
Yeah, I mean, a lot of those stocks have been really strong.
I don't know. Buffett's right again. Don't know.
I know we have a lot to talk about with Buffett. I don't know when
we do, but before we get to that, I just want to. Someone in the chat said Powell deserves a medal. Just real fast, and looking at the statement yesterday, kudos to the WSJ who does this great Fed statement tracker thing every single time.
Well,
what?
Spencer, you're starting to hear more of that. Have you noticed?
Hear more of what?
Really coming around to Powell. Is that did anybody have that take like a while ago?
Ever since he dropped the F-bomb, the market's just been in rally mode. So I think he did that on purpose.
Was that the sentiment turning point?
Cool.
Won't drop the F-bomb.
It's so seriously. Arun has a great chart of it. Like market just basically gapped higher the next day and just hasn't gone down.
Okay. You spend too much time on Twitter, I think.
I know.
Can we just talk about what a masterful job he's done? It's really easy to dunk on the Fed, right, and to blame the Fed for stinking at trading. But come on. This has not been an easy environment through the pandemic and then through, the fastest rising rate environment maybe we've seen ever. And now landing us on the other side. I don't know. Do we at any point say, hey, this guy's done a really good job?
I mean, I was going to say what Josh basically just said, which is more or less you can't argue with the price, right? So, and it's not even just the price; it's the price and it's the data, right? And sure, you could say that the only card left to play is that none of it is real, and if you want to say that, fine, go be my guest. But like for everyone else in the real world, I mean, it is hard to argue with the results. The results kind of speak for themselves, right? So.
Fed created the mess. This is the kind of stuff. Irresponsible. Okay.
Fed created the mess. Well, you could definitely make the case, I think, that the Fed took way too long to come off the gas. I think you can make that case. But regardless, I mean...
Do you think they hiked too much?
Or for too long? Too many times? I think you can make that case, but it doesn't matter. So it's all water under the bridge, right?
Was everything okay in the end?
That's kind of what I'm getting at, right? Like for sure you can make the case that they took too long to take their foot off the gas, but look where we are right now. Like it seems like it all kind of worked out.
There were so many analogs drawn to the 1970s as far as what's going on with inflation and the Fed. And it's, what you said kind of reminded me of it, Steve. Like, there's no playbook, there's no precedence of a roadmap that you're supposed to follow. So to that point, I mean, the ending hasn't necessarily been written yet. So I know we're at all-time highs and it feels like boom, victory, but
now
we'll see.
Could you say that they also cleaned up their own mess? Perhaps, but seems like the mess is getting pretty clean. I don't know. So anyway, the statement from yesterday, unusually, I guess surprisingly dovish is the takeaway. They added. There's only 3 changes in the statement. I guess 4 changes, but the one that people seem to be holding on to the most is they added the word any in. So there was a sentence in the 3rd paragraph in determining the extent of additional policy firming that may be appropriate, and they just added the word any. So now it says in determining the extent of any additional policy firming that may be appropriate. So people took that to mean that they're sort of acknowledging that they are, and actually Powell said this afterwards. He said, well, we are at or near the end of the rate hike cycle. So
you know, it's funny, and we can look at this when we look at the chart report, but Callie Cox had a great chart of basically like all the price action, intraday price action of Fed days, and basically pointing out that it's his comments that really move the market. The decision really, the market already has that, a handle on that beforehand, but it's really the decision and the specific words, the language can really matter.
I want to talk about the change in Fed funds futures. So,
yeah,
they finally, yes, they acknowledged that they are pivoting and that they're probably done. They're not totally taking it off the table. They're open to inflation maybe reaccelerating, right, and having to do more. They're saying, based on the data, the way it seems now, okay, they finally put into their projections, I think it's like 80 basis points of cuts next year, so 3 to 4 cuts. And Fed fund futures, I think, moved to 3 recently and is back at 4. So let's get that table, and we'll look through it later.
We are at a 99% chance of a rate hike by the May meeting.
What are you talking about?
Sorry, rate cut. I keep saying hike, a rate cut by the May meeting.
And then how many by the end of, by the December 24?
No, by June it's 100.
It's been a while since you've had to say rate cut. So
I know, I keep saying hike. What?
Go look at the December 24. Go look at the December 24 meeting.
Yeah.
What is the highest percentage is on what rate there?
The highest percentage for December 24 is on 3.25 to 4 basis to 400.
That's 5
basis points.
So they're pricing 5 cuts, right?
Yes. 1, 2, 3, 4, 5.
We're at 5.525 now, right?
We're at 525, 550.
Oh, so they're pricing 6.
1, 2, 3, 4, 5. Math is hard. Yeah, 6.
Wow. Okay. We'll see.
Aren't we at 525, 550? I don't even really know. And
then and this is for the armchair economists, not me, but isn't that what a recession looks like? 6 cuts?
I was thinking about that too, man. Like in the last 2 years, we also changed the definition of recession, and yeah.
I don't know. We'll see. Gunlock's out here talking about, overcorrecting, rates coming cratering down. He's been very wrong for like a whole 2 years now. Everybody's got an opinion. But for now, things look great. Semiconductors, home builders, broker dealers, new all-time highs. Powell came out with the pump yesterday. We always talk about, Brian made a great point yesterday. Be careful of the initial reaction. A lot of times they come out and reverse it come Thursday or Friday. It seems to me, again, 35 minutes until the open still, just judging by the pre-market action in like regional banks and some of these other risk-on groups, seems to me as though you're very much getting that follow-through here this morning, right? So today's really important, getting follow-through on some of the moves from yesterday and confirming some of those candlestick patterns. What are you rolling your eyes at?
No, I have a question for you.
Give it.
How bad would it be to see a reversal today? How bad would it be?
Not good.
Yeah.
I mean, listen, it doesn't throw a wrench in any of the primary trend stuff, right, that's developed, but it would probably not just be a one-day thing. If we got some really ugly, reversals here and some big red sticks kind of undoing the price action from yesterday, probably indicate, some sort of a corrective wave, even if just over the short term. And if you look at some of these stocks and groups and how overbought they are or extended, as you were saying, Spencer, would that be so bad? You know, after you look at the progress off the October lows and some of these things. So depends on the time frame.
No.
It's a valid question, and it's something to think about and be prepared for.
Totally.
And I think it also matters how hard it would reverse too. You know, if it completely erased yesterday's gains,
yeah.
But here's the other thing too. From a seasonal perspective, you hear a lot about December, right, and the Santa Claus rally and this and that. It's really the back half of December where you tend to see the outsized returns and the chase that has become so famous and has been talked about for like months now. The chase started like in October at the October lows, right? And is still going strong through the period that I'm not going to say seasonally weak, but relatively weaker than the later part of December, right? So if we're already chasing and the trend is bullish, you know, more bullish than the seasonals right now, then when the bullish seasonals kick in, which is basically, I think it's the last 2 weeks, right?
Pretty much now, yeah.
When that kicks in, are we going to go lower? You know, I don't think so.
Well,
I think
so that's a good point, you know, like talking about it within the seasonal context, because a lot of those things like the Santa Claus rally and stuff, people think it's just like a market gift. And it's like, oh, okay, market tends to do well in those 7 days. It's an indicator, you know, it's very good at predicting the next year. I know that sounds a little crazy, but that's really the takeaway with the Santa Claus rally. People just think it's like a freebie. No, it's really an indicator, and you want to watch how it performs rather than just thinking, oh, okay, this is we're gonna rally here.
Listen,
you know, and if that period is negative, that's not such a great sign for the next year.
So then let's take it a step further, and then we'll bring on Tommy Lackey. Good question from One Hole. So what is that indicator, Pat? So let's say the Santa Claus rally doesn't really materialize this year. What does that say?
Well, I mean, there's a whole bunch of, I'd have to go and really look at the data, but there's a whole bunch of different pretty telling seasonal indicators right around the turn of the year. There's actually one called the turn of the year indicator. But there's the first 5 days of January, the Santa Claus rally. I know I'm forgetting one other, but a whole bunch of really important ones. So
January
if
effect.
we don't get that rally, that would be kind of a sign that something might be up.
Okay. All right. Our guest here is chomping at the bit. So let's bring him on. Tommy Lackey, founding partner and CIO of Relativity Capital Advisors, an old friend of mine, first time on this show. So let's bring him on.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mr. Lackey, good morning.
Hey guys, how you doing today?
Good. You were in our little private chat here, just chomping at the bit, ready to roll. So, what do you? I'm sure you have comments on our discussion from the last half hour or so. So, what do you want to say about it?
Oh, I think it's great, actually. I'll write down my level in lines on things as far as how to do analysis and things like that, which is a nice, refreshing thing to say because, you know, one of the things I've said for years is one of the big separators in most technicians is if they actually do go with and work with breadth, because it's not in every free software out there. So you actually have to do a little more work to get there. But once you do, it opens up a world as far as what's going on in the markets. And the whole equal weight thing, I could go on with that the entire 15 minutes. So we'll save that for another day.
Well, say a little bit more just about how you approach internals, maybe. Like what are you doing when you say it's important to look at breadth? What are you looking at? What are you doing?
Well, I have a system and a setup that I put from a lot of the charts that I sent you that I put together myself. I've used since the 2005, 2006 after going through the big .com crash and deciding I was never living through that kind of stuff again. And in that realm, basically, it goes all the way from the things you talked about, all different ratio charts with other things and using that on both a regular strength standpoint or relative strength standpoint, but also a intermarket analysis standpoint. Actually, one thing you'll see on the macro page of my power investing site, which I didn't send today because y'all hadn't talked about it yet, but on that macro page, you'll see that I have an intermarket relative strength table because everybody talks about doing ratio charts on intermarket charts. Well, why not just use a relative strength table, so then you know which ones are stronger, which ones are weaker.
Yep.
And so you can do it even in that level, is using relative strength or even on almost an economic indicator from things like intermarket analysis and other scenarios there. So to me, you can use charts and data to cover almost the entire market, no matter how you look at it. Now, as far as what I was talking about is basically when you break down the markets further on breadth and you go past just the major levels and you start looking into sectors and what I call subsectors, you can't use the GICs because there are like 200 of them and some of them have like 4 securities in it. Doesn't really do you much good to do breadth on 4 securities.
Right.
And so what I did is I put together 51 subsectors that allow me to break it down into a reasonable scenario to where I can get breadth statistics, but still be in similar or very close industries. And so when you do it that way and you start looking at breadth down through the markets, it really changes the way you view. Right now, you're looking at my sector and subsector short-term breadth. This is just a little Excel thing I do for myself. It's not on the site right now, but will be eventually. And this just gives us a lot. The first one is how many are making new 10-day highs, what percentage of each one of these. Second one's lows. Third one's what percentage of the moving averages are above the 20-day moving average, or what percentage of the components. And then the final one is the breadth thrust indicator, which is a phenomenal oversold indicator when it really gets down there and gets washed out. And so this gives me an idea of, on the short term, where am I looking for new opportunities? Obviously, we see a lot of green here and some dark green, which means we're past the new entry standpoint in a lot of these if you're looking longer term. If you're a day trader, it's a different scenario, but this gives me a lot of daily aspect of seeing where the movement is, not just in price, but also in actual percentage of the components within these areas.
Tommy, I absolutely love this. This is the best way, right, to analyze breadth. Sure, you can use the equal weight indexes, right, and see how price is performing on a relative basis, but really you want to drill in. I think you've categorized these industry groups yourself. Is that?
Yes, sir. Not to plug, but I am going to plug. That website right there is something I've been building for 4 or 5 years that will go into a subscription service soon. Very low priced. I want everybody to have it available because I think if you can dig in like this, you can really start separating yourself, whether you do ETFs and do themes or whether you're going to go all the way down to the individual stock level. You really ought to take a look at the site. It's a lot of fun.
When it's ready, let us know. We'll bring you back on and talk about it more. But
it's already up. You can play with it now. I'm just continuing to add features.
When you actually drill in and look at what each individual component is doing in each group, that's real breadth analysis. We get caught up and lost a lot today when you're just sifting through on Twitter and somebody drops a really, sexy chart of percentage of stocks making X new highs. That's fine, but that's more of like an aggregate approach to breadth. Go look at the underlying charts themselves. Flip through all of them, all 50 charts in this group, all 100 charts in that group, right? And that's really how you get a feel for what sectors or groups are working the best. Are you then drilling in and looking at all the charts too?
Well, yeah, I think you've got to start and work down. Now, of course, I can't look through all 3,000 charts every single night, but that's the whole purpose in this. Is it allows me one of the best funnels I've been able to develop over 20 years to get me to those charts quicker.
And so what you mean by that, for example, the banks, right? It tells you where to look. You see that dark green on the banks, 70% making new 10-day highs. Then you say, okay, you drill in, you open up your bank watch list, and you look through for opportunities in that space.
Mm-hmm. And this is everything we're talking about right now for where we are right now is perfect. But I'll tell you where I like it the most is on the opposite end. When the chart is so red, you can't even see anything. And everybody hates the markets like nobody's business. It is so much fun to start putting money to work at those times because, as much as there are individual stocks can always go to infinity and to zero, sectors can't. So they are the true depiction of the stretched rubber band.
Right. They
can only stretch so far before there's going to be some money that goes back into it. We just have to be able to identify when that's happening.
Would you say like real estate maybe was a good example recently? Really?
Oh, huge. Real estate and utilities both were good examples. Now, here's the problem with those two, which you also, if you're a portfolio manager, you have to be aware of, is they may have been super oversold and they may have come out, but you still don't put a huge allocation there because they don't have the amplitude or the velocity that other sectors do. No matter how the utility chart looks, you still may get more return or more bang for the buck out of getting a good setup in consumer or actually communication services right now, which that was a perfect one in January of this year that I got into because of that weak breadth and been down for almost 2 years, and the markets turned strong quick. That was a great one that breadth really led us into early.
Now, do you say that about real estate and utilities simply because the moves, they're just still, they would still just be counter trend in nature, while there's some other groups where the primary trends are higher?
Well, no. I mean, again, they're an allocation in a portfolio. Like example is they may be in an allocation in a portfolio for real estate or utilities, kind of like a bond alternative. If you're seeing good things, and they're still going to move faster than bonds, but in a strong market, even if they are moving strongly, they're not going to outperform most technology. You
want your offense on the field in bull markets. Is that what you're saying?
Correct. Even if they're doing well, I still want the guys who have the biggest ATRs. I want the guys that are going to be moving for me on both the sector and on its individual stock level.
So what are some offensive groups that stand out right now? I know a lot of them are starting to work.
I mean, I was looking at a couple as far as the running. Y'all were talking about these charts are hard to look at and try to find a good entry to earlier. That's one of the issues you run into. It depends on your time frame. You know, with portfolio managers, guys who are managing monies and RIAs and things like that, some of these are just now starting to go to where you could start a position here, even if it pulls back, you do a third now and you continue to do a third until you get to your floor or things like that. If you're a day trader, yes, it's kind of tough. But if you look here at this one, this is my equal weighted subsector rankings. And this just shows over the last month which ones have moved the most RS points. Now, this is a 3-month art relative strength. This is something I developed 15 years ago, almost 17 years ago, while everybody was using 6 or 12 month and just starting to look at 6 month. I was turned to 3 month because I was doing a lot of sector ETF trading. Right. And the 3-month allowed me to spot them quicker and earlier. So I use a 3-month as my primary, and then I go to a 6 and 12 month for confirmation. But when you look at this here, biotechnology is a great one as far as it could be on a major reversal standpoint and from a standpoint that you don't think of. If small caps do come back, there's a large constituent of those in there. And if interest rates are peaking and coming back down, that's a very interest rate sensitive type of a sector. So that's a sector that I think this turnaround should be watched after a couple of years of underperformance and could be a real strong one for a good while. Again, if you're an ETF player, you can play in and out. I like to do what I call a core and a ratchet position, where I have a partial position I just want to hold. And then I have like a third of my position I'll trade in and out as the technicals top out and come back and things of that sort. And then if you're going to individual stocks, you just got to look at it daily. And on every one of the pages, because I have a page for every one of these subsectors on the site that looks exactly like the main page. So you're looking at the same data every level, which makes it easier to really decipher and get through it quicker. And then at the bottom of every one of them, it has a relative strength table that has every single stock on it that you can filter, you can sort, you can do all sorts of things to really break down and find the ones that you want to dig into. It's not always the strongest relative strength you want to be buying. In fact, my favorites are the ones that are moving the most in relative strength, but are currently at probably a 40 to 55 absolute relative strength rating. Because those are the ones that have probably got a good base under them and are starting to turn more likely. And how are you calculating that relative strength score? That's not something I'm willing to share. Got it. It is a proprietary calculation. It's a 3-month front-weighted calculation. And it's all price-based.
Interesting.
You know, you talk about biotechs. We were just talking about the banks. Both of those things seem to me like groups that we'll be talking more and more about in an environment where maybe small caps are leading or at least completing this little reversal pattern that's in play in the Russell. No? Well, the banks and financials absolutely will be. There's no doubt they will be huge as far as what comes up. Now, I'm a big fan, like you put out there, broker dealers. I'm more of a fan of that area because I believe there, again, is more amplitude in those types of stocks when they do move. Mm-hmm. But on the other side of it, the banks are the ones that are beat up and have some catch up to play. And that's just a strategy. And that's the thing is none of these strategies are right. It's where you're most comfortable putting your money. and that's something we talk about so much, right? If you're going to use the broker dealers as your vehicle, then you're making a bet on continued performance from the leaders. If you're going to use the regional banks, say, as your vehicle, you're betting on some sort of a catch-up trade or still mean reversion move, right? More tactical trade. And it's not to say one is better than the other. One might be higher probability. The other one's probably higher risk reward. But I think there's room for both in any portfolio, right?
Yes, and it depends on your time frame. It depends on who you're trading for, what kind of portfolio. Because, see, I do portfolio management, but I consider myself a position trader.
Yeah.
I want to hold on to it as long as I can, but as soon as I'm uncomfortable, I'm fine bailing. And so I'll ride through some stuff that other people won't here and there if I'm still comfortable where I'm at. But if something makes me unhappy, I'm gone. Real. And that's really basically from a position trader standpoint, like in XLC first part of the year, that lasted, I think, 9 days. Because I had made 20% in 9 days. And after such a cruddy 2022, I wasn't about to hold on and see what happened. So I sold it. It pulled back about 10% of the 20%. I bought it again and I'm still holding it. And so it gives you a different view of kind of where. Now, again, they're not all that good. Sometimes I hold too long and it ends up beating me up and I pay for it. And I've done a few of those this year in this market because I think this market was much tougher than people were willing to realize. And you're talking about a catch-up play. The charts I sent you on medical equipment and services is one that kind of really caught my eye from a catch-up standpoint, is that it's literally the lowest relative strength sector within healthcare right now. But if you look at that first RSI chart that I sent you, boy, that looks pretty. And that's an equal weight chart of all the stocks that I have in mine. All the stocks that are in mine are any stocks that are trading over 100,000 shares and they're over 500 million in market cap.
Yeah.
Those will be in my universe. It's about 3,000 stocks right now. It changes every single day because that will be recalculated every day. If they drop out, they're gone. And so with that kind of scenario, it gives us an idea always of what's in there today and how it's performing.
They remind me of biotechs, the medical devices.
And they got merged there towards the bottom.
Yeah, I mean, it's a beautiful RSI chart. And see, one of the things I've seen JC do a little bit more, and I've done for decades, I used to work with Andrew Cardwell before he passed away on RSI. He really is the king. But when it comes down to it, it's basically, if you notice on my RSI chart there, there's 2 red lines and there's 1 green line. There should be another green line up there top. I don't use RSI as overbought, oversold. Overbought RSI is awesome. Basically, I use it as a range rules to where basically if it's between those green lines, which you don't see the upper green line right now, it's in a bull range. If it's below those green lines, it's in a bear range, or below the red lines or between the red lines. And if you look at that chart right there, that's a perfect depiction. Because as long as it was rotating between those green lines, it was going up or sideways. As soon as it dropped and it couldn't get back above that red line, it's in a major downtrend. That's the way to use RSI right there.
That's good. Do you have any specific names you like right now?
On that one, I would say throw up that last chart, and if y'all can put it in y'all's chat or whatever, to where I put in the last table that has the names in that space. I was doing all these to put together, so I did not pull out a ton of them. The charts that I've sent y'all, if y'all did decide not to go down the whole analysis path, y'all were just going to straight charts, were just different charts that I pulled out of my relative strength rankings for the day. For anybody who's taking a look at the site, if you go under the universe page, there's a drop down and it has all 3,000 stocks ranked against each other that you can filter and you can do all that. The other real quick thing I'll bring your attention to, anybody who's on there, is if you look over to the right, there is an RS, is a relative strength. What's the name of it right now? I think it's RS snapshot or something like that on that menu at top. I'm trying to make sure I'm reading it right. Custom RS snapshots. If you look at that, custom RS snapshots on the actual website, not what I sent you, you can actually put in your own tickers and it will create my relative strength table with just those tickers that you put in.
All right.
And so like if you have a 401k that only has certain options or things like that, you can type them in here. It takes stocks, ETFs, and mutual funds.
Before we get you out of here, let's talk about some of these names. You brought some individual charts. The chat loves trade ideas. Marvel, Beezer. Which one should we throw up?
These were some of the ones that even in like Marvel's a good example. Or in a sector that's really taken off, Marvel is one that looks like it's about to play some catch up. And so again, we got one of the strongest sectors. We know Marvel's a name that's been around for a while and not a bad name here. And this chart really looks to be shaping up. no matter how you look at it. RSI is moving into a new bull range on the daily. The weekly held the RSI bull range down there on the last pullback. The volume profile or footprint on the dailies really picked itself up over this last move higher. We've got an inverse head and shoulders about to break out. We've got a downtrend that it broke, back tested, and is now coming back above. What else do you want?
Yep, I like it. Semiconductors, it's just a great pond to fish in. And it's also these large but not large cap tech stocks seem to be catching a lot of flows right now. So
that's exactly the point. Y'all made the comment about what happened if the Magnificent Seven took a break and we're down. That'd be awesome because that money's going to flow into other things right now because the confidence is coming back. And again, fear is the biggest thing that basically hampers markets. As long as we have, I understand a wall of worry, that's different than fear. Those are two different animals. And so from that standpoint, as long as we have people wanting to be in the markets, the Magnificent Seven, it's time for them to take a break because you're right. They were the safety plays of the last 2 years. And now people are starting and willing to spread some money. And that's really our job to find the themes on an ETF level or the individual securities on a stock level, depending on how deep you want to go.
All right, Pat, what do you got?
So I love the point you made about RSI there and how overbought isn't a bad thing. I mean, it kind of sounds bearish, but it's a great point to be talking about right now because RSI on the S&P just hit its highest since, I think, September 2020. So when you see that, how do you think about that? Is it one of those things where, we have to correct now?
It's one of those things where, again, you got to look for the correction, of course, because you are getting to a level. But the part that people don't realize that they don't really understand RSI is being a bound indicator is that the higher and higher you get, every point higher it moves, the larger the stop move or the market move or whatever to get it there. So when you quit early just because it's overbought, sometimes you'll leave more than half of the move on the table. So again, no one's going to catch the top. Don't try. Work your way through it. Allow the market to tell you, find your own levels, whether it be a pattern up there or something like that that tells you they're starting to sell. The indicator is just your pre-warning.
Yeah.
But I also believe divergences are one of the things Andrew Cardwell taught me years ago. Until the last one, which we never won't know which it is, divergences are only detours. They come in some of the best uptrends you'll ever see. A bearish divergence will come in the best uptrend you'll ever see, but with an RSI, it'll fall into what you call a positive reversal, which is where basically the price will make a higher low and the RSI will make a lower low. Some people call them a hidden divergence or things like that. They're called basically a positive reversal. And to do that, that's basically that scenario to where when you're coming in to where the RSI is moving down real fast, but price is not following it real fast, and then it reverses back up to make that cup. That's a huge buy signal, usually. Okay. Now, again, they can fail like every buy signal, but that means you're still in an uptrend. The strength is still there, and they're ready to buy it back.
A lot of times,
I've never heard of that positive RSI divergence in terms of that.
I have a whole series on my actually gtlackey.com website that I wrote in 2011. It's still there. I don't do anything with the site anymore or anything, but it's still there if anybody wants to read that series about as far as how I break down RSI.
Tommy, got some new fans in the chat. It's been too long since we spoke, sir. So great to have you on today, and we'd love to have you back on.
Well, thanks for having me, guys. I'd love to come on anytime y'all want.
All right.
And feel free to reach out if you have any questions on the site. It's a lot of fun, and I'm trying to add new stuff all the time.
All right. Tommy's handle is on the screen. It's in the description as well. Thanks a lot, Tommy.
Great stuff.
Thanks, guys.
Thanks.
See, I knew you guys would like Tommy.
That was awesome.
Listen, super cool. Anybody who's going to come on and just, walk through a top-down approach like that, which is very detailed, seems like he's doing a lot of work around it, and speak to relative strength and the importance of relative strength, right, the way he did, good by me. So website looks great. Go check it out. Also, just to wrap up that conversation on momentum, talking about it the other day, Pat, I forget what show, but you want to be patient in bull markets with these RSI 14s and other momentum indicators. They literally, mathematically, they lag price, right? So if you have new highs in price and it looks like momentum is diverging, negatively, sometimes you just have to be patient and let it catch up. Or as Tommy said, view it as the opposite. If momentum cools off and ticks lower, but price is still holding up, then it just has a lower level to come from, right? And could act as and be like the surge or the fuel needed for a new leg. And you see that all the time.
Oh yeah, and you can have an RSI divergence for years, right? We've seen it a million times.
That's why I removed the RSI from any of my non-daily charts. Weekly, monthly, it's too long. It lags way too much for me. What you would have to do, I think, for it to be more effective, which I've experimented with, but I just don't care enough about the momentum indicator, is you would shorten the period, 9, 7, 5 on a weekly or a monthly. 14 is just way too long. But the more important matter, and what I do love RSI for, is the regime. It just tells you about the character of the trend, right? If it's constantly hitting overbought during up legs or rally phases, and then not hitting oversold during corrective waves, that's a bull market RSI, right? And it's really, really excellent at distinguishing between bull and bear markets.
Yeah,
yeah,
for sure.
I wasn't familiar with his work, but that was really interesting stuff.
Should we bring on Mr. Alfonso?
Hell yeah!
All right, Fonz, I got your bumper. Let's go.
Wow.
Alfonso.
Hey guys,
How's
it going?
By the way, whenever you see like the charts on screen, that's Alfonso.
I love it. His handle is just
the
the
bumper.
chart.
Just the charts. Fonz, what are you seeing out there, man? A lot.
Yeah, I mean, you guys mentioned semiconductors making new all-time highs, home construction, home builders making new all-time highs, even broker dealers also breaking out to new all-time highs. And one sector that I think it's really important to have into consideration is the industrial sector. So I bring some charts here. So this is industrial sector XLI making new all-time high, the most correlated sector to the major average, the most diversified sector also. So this one is a big chart for me. Within industrials, I'm seeing aerospace and defense. That chart caught my attention last week.
Man, that one had tried to break out for so long, and it finally went.
And it's finally going. It seems so. It represents almost 20% of the industrial sector. So I think as long as we're above 120 in ITA, I think industrials will do a good job, and that favors broadening expansion and participation underneath the surface. And the same thing happened when we go down the cap scale and we see small cap industrials making new all-time highs also. So if small caps industrials are making new highs, it's really hard to be bearish U.S. equities right now, in my opinion.
Yeah, it's hard to be bearish. Pretty much anything, not everything, but most things, right?
Yeah, no, definitely.
So, I know you had a great chart of the German DAX the other day. Do you want to talk about the breakout and kind of what it means for the broader market and how you're looking at that?
Yeah, I don't have the chart right now of the DAX, but it broke to new all-time highs.
Looks very similar to that industrials chart.
It's very similar chart, and we're seeing a similar behavior, I think, in France in the CAC 40 index this month or this week, making new all-time highs. So it speaks, broadening participation is not only the US that is rising; it's all the entire world. In fact, European indexes and stocks have been leading the way higher since we bottomed last year. So that's what I'm seeing right now. And Steve mentioned what kind of ratios we use or you like to see to measure risk appetite. And I bring this chart. This is industrials relative to consumer staples overlay with S&P. It
Great
tends
chart.
to act like a leading indicator. It's making new highs. Same thing for the S&P. So as long as this black line is going up, I think, market are in a healthy type.
Yep, absolutely. These charts look very similar over time. There was a recession in 2018. I got to add a shade there. And it speaks to any of the other risk appetite indicators, right? Whether it's high beta, we talk about these relative reversals in some of the ARK funds and speculative growth indexes. We come on here and talk about reversal patterns in cryptos, right? We're seeing more and more risk on evidence. And I think you make a good point. International kicked off this new bull market with the Dow last year, before the NASDAQ 100 had even bottomed and started participating, right?
Yeah.
Don't rule out a world where we see that again, right? And Europe really picks up the slack here. A lot of failed tops in these international indexes, a lot of really strong rallies and reversal moves off of those failed tops, right? What do you think? Is it time to start looking more overseas? I know you do a lot of the ex-US scan work. So.
Yeah. As I mentioned before, European equities have been doing great. Germany, if you look at Spain ETF, Italy are reaching new 52-week highs. But an area that I'm interested in right now is Latin America, because when I look at this chart, it seems like it's carving out like a nice reversal pattern. There is a multi-year downtrend trend line. So I think if we get a breakout above like 29, 30, I think, areas like Latin America are a good place to be.
I mean, how good does this Spain ETF look too, though?
Which one?
ILF, good, but Spain looks even better.
Yeah, Spain looks great. We have been pounding the table in European banks. Spain have a lot of exposure in banks. So it makes sense to see the Spain ETF looking good.
What do you think of Argentina? I know that's one that's kind of really taken the lead in the last few weeks.
Yeah. Let me talk first about Brazil. I have an Argentina chart later, but here is Brazil breaking out above 34. That's a classic random bottom formation. So new high for Brazil. It represents a lot of ILF. So it is a big country in Latin America, the most important in my opinion. Then I think Mexico. It represents, I think, 25% of ILF.
Look at this chart.
It's pressing against those former highs. So
pre-financial crisis.
That's right. So I think if we're above 65, it's good.
Almost a 20-year base here.
I love this chart.
Right. This is like, JC always makes that point. Energy hasn't even broken out yet. You look at XLE, looks the same way, right?
And we could say the same thing.
I know, and we're waiting, and we're waiting, and we're waiting, and we're waiting.
And good point. You have to be patient with these, right?
We talked about this 6 months ago.
Right. We might talk about it 6 months from now, and it still hasn't gone. Go look at a chart of Pfizer. Sometimes they never go.
Yeah, that's true.
It takes time for buyers to absorb overhead supply at this big basis.
You get false starts, failed moves. It could get really choppy around these breakout levels, but when they go, some of those on bubble bases, you look back now, man.
Yeah.
Fonz, you're going to stay on for the hot corner. Surprise.
Yeah, definitely.
Oh, man, should we do that? Let's do that right now. We got some good.
People need to know about Uncle Warren.
We got some good. Oh, yeah.
So hot right now.
Fonz, why don't you do it? Take it away. What happened?
So Warren Buffett bought a lot of Oxy. Again, the last time he bought Oxy was in June. So now he's buying back like a huge amount. I think here we have this chart. We have been put on the table that Warren Buffett is buying accidental petroleum every time that price is below 60. Even here we have accidental petroleum. We call this the Buffett zone, above like 55, 56. So he has been accumulating a lot of stocks, ownership around 35%. And here we have this table, Steve.
Yep. This shows all of his purchases. I mean, look, he came out with size that we haven't seen since March with this purchase, right? Because you could see if you look at the cost basis, right? Each time he came out and supported this level, he started reducing those purchases. You know, in the beginning, he was coming out 3 billion, 1.5 billion, right? 900 million, big purchases. And then into this spring and summer, really starting in May, 200 million, 100 million, 200 million, right? They got smaller. Yeah. Yesterday's filing 600 million, right? So he's coming out in size again, really continues to be the support at this level. Talked about it. And I started to think, you guys know, I started to think this one's going to go. He's done supporting it. This top's going to complete. But no, and if you have $600 million getting thrown at those former lows every time we get there, you're going to see massive rebounds like the one we're seeing right here today. Oxy really being buoyed by this news, which we've seen so many times before, up what, 3.5% today?
Yeah, I mean, are we just prescient? Pat ourselves on the back here. Was it Monday or Tuesday we were talking about this? And
We talked about this for a while on Monday.
Yeah. I mean,
and
credit to us, huh? Credit to us.
And you got that classic shake, right? What was it? New 52-week lows or something? Almost new 52-week lows. Just like Brian Shannon was talking about yesterday, right? At support, you get the shake, and then Buffett comes out with the big buy, and it's just rocketing off that level again. While it's one thing to be happy in a situation like this as a trader or an analyst that our level continues to hold, it has been for like 2 years now, right? What hasn't happened over that time is any objective or price target getting hit. It's been dead money. It's been opportunity cost, right? So we don't just want to, get something at a clear level, right? That's part one. We also want to buy something that's trending, and this has just been so messy. It's not to say that it won't trend back to the upper bounds of that range and eventually break out, but does it happen this time, next time? Does it take, 6 days, 6 weeks, 6 months, a year? We don't know. So that continues to be the problem with energy, I think.
That's right.
Yeah, it almost seems like every bounce kind of, you're getting less and less on them. So something to watch for.
Top stuff, distributive stuff, right?
Yeah.
What else do we have in the hot corner funds? Anything? I mean, nothing nearly this interesting, obviously, but was there? Yeah, there's a bunch here.
How could you want to talk about anything else?
I just want to cover my bases here. So, no, nothing that interests me. I just want to see.
We saw insider activity in one of the regional banks, Texas Capital Bank shares.
Hey now.
So we have been seeing that insider activity coming to regional banks basically all year. So it makes sense.
Yeah, and so I'll do that standout. Heartland Express, they keep buying this thing, and I always have a good time. I have fun when we have recognizable names on our list. Let me see what we have here today. And anybody a fan of the All In pod?
No.
So
Sorry.
D1 David Sachs, very popular these days, right? Like a big political guy now. That show is really transformed into something different than what it started as, but I still enjoy it a lot. David Sachs of Silicon Valley, right, and software company fame, out here buying a farm construction and heavy equipment name, Terex. Throw up the table again. David Sachs from, what was he, PayPal with Elon Musk, I believe?
I honestly don't know.
Part of that crew? Yeah. So buying Terex Corporation, TEX. I don't know.
I mean, that doesn't sound very techy to me, but
Not at all.
I don't know. I don't know. I guess I don't have an opinion.
No opinions.
No, not really. Sorry.
No opinions.
Nothing. Yeah, that's
Okay.
weird.
No.
Like
Nobody
a
else listens.
big purchase
Yeah,
at the end of the day. So
he's got the money.
Yeah.
Nobody else listens to the All In Pod.
No, I'm not a fan.
Wow.
I'm behind on my actual podcast. I can't take on any more right now. Too many.
Capacity.
Yeah. Okay, let's do some news real fast, and then we'll bring Sean on. I want to talk Adobe. Down this morning. Last I saw was about 5%, but that was before the open. Earnings after the close yesterday. Earnings were okay. Guidance was not okay. Guidance was light, and they revealed an FTC probe into their subscription cost practices. So weak guidance and an FTC probe is going to usually hit the stock the next day, as it's happening this morning. So that chart doesn't reflect this, but you can see, obviously, if you pull it up, we're in the red. Speaking of earnings, we do have Costco tonight. I want to talk about Moderna, which the CEO was on CNBC a couple hours ago talking about their cancer vaccine. They had some data come out this morning in partnership with Merck. They've been working on this combination with Keytruda, and they have a vaccine for patients with high risk stage 3 and stage 4 melanoma. And they had some good data come out today. They were talking about this vaccine being available as soon as 2025. So that's helping the stock this morning. U.S. Steel, this came out yesterday morning during the show, actually. David Faber reporting that they have multiple offers on the table above $40 a share. We know a couple. We know Cleveland Cliffs. We know ArcelorMittal. I'm saying that right. But U.S. Steel apparently in play. And I think that was it. U.S. Steel, Moderna, and Adobe. I think that was all I had on my list to talk about.
U.S. Steel, I mean, it's just not the vehicle you want for that space anymore. I'm a little bit frustrated. I've been in Steel Dynamics. It hasn't really been working for a trade. It's frustrating, right, when a group of stocks is really working and then the vehicle that you chose is super underperforming. A lot if you do this regularly, trust me. I did jump into Freeport yesterday amid all the volatility and got a pretty good fill in it. But these stocks just ripping here again today.
That'll never happen to you if you buy an index of an industry group. I'm just saying.
So another slow day for news. Is it safe to say?
Maybe for individual headlines, but everyone. I mean, the news is the market going up. That's the news, right? The news is that things are going up and to the right.
Okay, so real estate and materials, big leaders today. Office REITs, hotels, healthcare REITs, industrial, and then aluminum, silver, gold, copper, agricultural inputs, all up 3% or more. Energy also 1.6, 1.7% here this morning. It's the drill.
3% is a huge move for gold. I mean, that's and it moved like 2% yesterday. So we've seen like a 5% reversal in gold the last 24 hours.
Gold is
maybe not 5%, but
gold is looking like it might actually get it done this time, huh?
Yeah.
So rocketing back towards the upper bounds of that range comes in right around low 190s in GLD. We'll see, but a big move here just over the past 2 days. And then in energy, it's the groups that you want to see leading, right? The E&Ps, the drillers. So risk on tone there. Consumer cyclicals up 1.5%. Communications doing well. Industrials, financials, but not as much as the other value groups. And then rounding out the bottom here is your consumer defensive, your healthcare, your utilities, so all the defensive stuff, and then technology.
Small caps leading by a pretty wide margin again. So we're really seeing that kind of seasonal rush back into the laggards there, that beating up small caps.
That's the way it's been, though, Pat.
Yeah.
Same shit, different day.
Yeah.
And look, like the same kind of thing that we've been talking about all week. Apple up 0.5%, Google 0.3%, Amazon 0.25%, Microsoft is down by almost 1%, Nvidia is basically flat, Meta down 0.5%. In a tape where there's not much red at all, right? Just the fact that some of these Magnificent Sevens are lower or not that much higher, some pretty big underperformance from that group of leaders here again today.
Look,
Yeah, and Apple just broke out. Like some of the other ones have been near all-time highs. The biggest stock just broke out of a 3-4 month base. So,
I mean, frankly, if you're here crying about your Google and your Amazon, lagging in the last few weeks, cry me a damn river. I mean, I have no sympathy for you. Okay, after the year that these stocks have had, okay, get out of here with that. You have no leg to stand on. These stocks have dominated this year. So get out of here with that crap. Okay, should we bring on options, Sean? I think we should.
Hell yeah,
I'm gonna do it.
do it.
Also, Elijah says that's not the same David Sachs, Steve. I don't know.
Yeah, I'm afraid he's right.
Okay.
Anyway, it would have been cool. Said it was.
All right.
Doesn't matter.
Man, I got the short end of the stick following Fonzie and Tommy. Man, how do you follow those two guys?
You just do, man.
Hey, it was great seeing Tommy. I haven't talked to Tommy in a long time. Old friend. Great to see you, Tommy. If you're still watching, awesome to see you, buddy.
Sean, is that snow outside?
No, there's no snow outside at the moment, but there is snow coming.
Oh.
Must have that look.
It looks like maybe just the lighting. It looks like there's snow to me. Anyway, what's on your mind, man? What you up to?
I mean, what's on my mind is what's on everyone's mind, right? Like, what a rally yesterday. What follow through today? I mean, I'm raising stops left and right on all these bullish bets, which is great. We got out of coin this morning at our profit target. Look, you got to remember these days, because these days make up for all the other days that suck. So you got to enjoy them while you can, right?
That's right. So what did you walk us through sort of positioning wise? What have you been doing the last week, 2 weeks?
Talk about what's been working, Sean.
Well, I mean, I'm a broken record. Anyone who's been watching me and Strazza over the last few weeks, I've been pounding the table on the hard trades, and the hard trades are the ones that are kicking ass for us. Uber, Coinbase. What are some other hard trades we're in? IBM, RSG. I mean, these stocks just keep ripping, and nobody wants to buy them because they're up so much, but they just keep going. And that's the environment we're in. Now, for new trades, I'm not necessarily looking to put on the hard trades now. I mean, there's still hard trades, but I'm more looking now for stocks that, maybe need to play a little bit of catch up, perhaps. KeyBank, a trade that we put on last week, was a great example of that, and that one's working awesome. What did we put on yesterday? We put on Autodesk. That one feels like it's about ready to play some catch up. We'll see.
Already, I mean, you entered it yesterday morning, I think, right?
Yeah.
I mean, it's already up 10 points.
Yeah. Well, there was a thing that happened yesterday afternoon. The Federal Reserve kind of launched everything, so I can't really pound my chest on that one.
Tightly coiled. These patterns keep working. I mean, the logic there was these stocks are catching flows, right? You mentioned in your post, I think it's these less than largest but still large caps, even in tech, even in growth, that are really seem to be benefiting as much as any stocks from the profit taking and the big winners. Autodesk really falls into that category. We looked at the base there. We said, we've bought how many of these bases this year, and they keep working. Why wouldn't this one work too? That's really it.
Right. Well, Straz, I'm glad you popped back on, because we got out of Coinbase this morning, hit our profit target. And, we were discussing yesterday during our private Q&A for the Portfolio Accelerator. We were talking about coin and Yeah, we have a profit target right here, but it really just started ripping. Why not hold longer? And that's not a terrible argument. The argument that I made was I was in a bull call spread, which means I'm long a call and short a out of the money call. Well, that out of the money call was out of the money when I put the trade on. Now it's in the money. The whole spread is in the money. My upside is capped. Can't really make that much more from here while still holding all the risk. So that's why we got out of coin, following the plan. But also, I added other crypto exposure recently. Which basically was an add-on trade. We got long MicroStrategy. So I actually feel really good about taking coin off here. It's kind of like taking profits off while I still have that MicroStrategy play for further upside if there is further upside.
Absolutely. And there's just, in some of these stocks, whether it's coin or Uber, right, that have been so overbought and so extended for so long, there's stuff that on a tactical time frame we'd rather be in, like the Key Corp, or even like look at MicroStrategy. Coiling doesn't look nearly as extended as something like Coinbase, right? There's so many so many things working, new bases or new little coils breaking out every day. Put it into that, and you could take it out of some of these ones that look super extended and are losing momentum, because I think you're just stacking the odds in your favor of being in something that's working over the short term.
Well, look, now that we've laid that table and prepared that table, I want to drop something in. This is not something we've talked about, but something that I'm hoping someone smarter than me will put in the effort and figure this out. But today is the last day that anyone holding S&P options, SPY options, tomorrow it goes ex-dividend. Okay. So what that means is anyone who's holding stock on record as of today's close, they earn the S&P dividend. Okay. Who cares about?
Is this a once a year thing?
No, it's a quarterly thing.
Okay.
It's a quarterly thing. Now, we're not dividend players. We don't care about dividends. That's not the main point. But what I have noticed, and it's anecdotal, and what I feel like I've noticed, I'd like someone to do the research. Maybe we have somebody on our team do it. I feel like I've noticed that on every ex-dividend day, so tomorrow will be ex-dividend, meaning if you bought the stock tomorrow, you're not entitled for this dividend that's coming next. I feel like many, I'm not going to say all, but many of the last times, let's say at least 8 out of the last 10 times that we've had this ex-dividend day, the market has marked a short-term peak. I'm not saying the market's this is the end of the bull market, and I'm not saying we're in for a correction or a crash, but at the very least, I would not be surprised to see stocks for the next 2, 3, 4 days take a little pause, maybe come back 1 or 2%, and that would be totally normal. If someone could dig into that and look into that, I'd be really grateful for it.
A peak in what? A peak in just
a peak into is it become a pretty reliable indicator that the ex-dividend day marks a short-term peak in the S&P 500.
Okay.
I don't know why it would.
Well, there's
a
a lot of theories to it. I mean, from an options trading perspective, we talked about this yesterday or recently about Uber options, right? Like everyone knows that every portfolio manager in the world that tracks the S&P 500 has to buy Uber stock as of, what is it, next week? Someday next week? Everyone
18th.
knows that.
Friday.
Oh, tomorrow?
Tomorrow.
Yeah, it's because it's Monday morning. Yep.
Right. So we've been seeing Uber stock going up straight up basically for the last month. And it's been known that all these portfolio managers have to buy Uber, but they're not buying it yet because they can't, they're not tracking the S&P yet. So we have a lot of people out there who, perhaps some portfolio managers who they can't buy the stock yet, but they don't want to get their face ripped off by buying the top. So what they might be doing is buying calls, right? So that they don't have to, so they can get it at a better price later on if it keeps going higher. Meanwhile, the person the traders on the other side of that trade are market makers who are shorting the calls to the big players, right? And market makers, they don't want to take directional bets. They want to be delta neutral. So the only way they could stay neutral in that trade with their short calls is they have to buy stock. So I made the argument that it's probably market makers who are driving this rise in Uber right now, or at least this most recent leg higher in Uber. And you might see a little bit of that in SPY as well, right? You see people who, for whatever reason, want to get that SPY dividend. They're all buying the stock right now because they want to be, on record to collect that, what they feel like is free money, and they're buying calls to get into the stock, or they're buying stock. And once that trade is done, once everyone is on the record as of the close today to collect that dividend, well, the hot money might look to exit tomorrow or soon after. And I'm not saying that this happens, for everybody, but I think there's enough people to do this trade that might have a repeatable. There's a pattern here that develops, I think, every quarter.
Maybe I never thought about that.
Putting it out there.
I've never thought about that before, but I think what you're saying, it sounds plausible to me. I'm no options expert, but it sounds plausible.
I mean, everyone likes to say, not everyone, people outside of our room like to say that the market is fully efficient, right? It's a random walk, all this stuff. Markets are efficient to a point, but there are some structural things that we traders who've been around the block can take advantage of. We know certain times of the year or certain things and certain events that market makers have to position in certain ways for. And if you're smart and if you're sharp, you can take advantage of those things. And I feel like, dividend plays and things going ex-dividend is one of those things, which, by the way, I'm no expert at making that trade. It's not a trade that I do. I don't buy stocks to capture the dividend and do some kind of arbitrage. I don't do that, but I know that there are a lot of people, big trading desks on Wall Street that do that, and it's bread and butter for them.
Yep. I know people that have been surprised. They were in for a rude awakening on the day of the dividend. Like, why is my stock down? It's not down, you dummy.
I had a rude awakening one time.
It's not free money. The money has to come from somewhere.
Well, I had a rude awakening one time, and not that long ago. I think maybe 2 quarters ago, where I was short a whole bunch of S&P SPY calls that were slightly in the money on expiration day, or right before ex-dividend day, which I did not think they would get assigned. I thought they were just not far enough in the money to get assigned, but sure enough, they got assigned, and I owed a several $1,000 dividend a month later to all those people who assigned that stock against me.
Yep, that'll happen.
That's no fun.
No. All right. I have nothing else on my list here, unless Pat, Steve, Sean, you have anything? We can just go. Oh wait, we didn't look at the chart report. Pat, do you want to?
Yeah, I got some stuff.
Sure, if you want. Man, I'm just looking at the Russell 2000 here, already back at the top end of the range here, testing that 200 level. We got there quick.
Oh wait, Steve, wasn't there something you wanted to talk? Oh no, that was for Friday. All right, what's on your mind?
Let's talk about these intermarket charts. Do the chart report first. I'm just dropping some charts on the deck.
Alrighty then. I gotta go find my chart report. Thingamajigger. There we go.
So you know what the big story was. The big story was, of course, the Dow. We used this drawdown chart, basically pointing out that this was the longest drawdown. COVID, we fell 35%, or the Dow fell 35% during COVID. So it was deeper then. We fell about 22% this past drawdown or bear market. But that COVID one only lasted like 9 months. So this was the longest drawdown bear market since the great financial crisis. And, they always say markets can correct through price or time. And I think this was a little bit of both, the COVID decline seemed to be through time, where it just really priced it in, then real fast rebound. The 08 one, you didn't recover the 2007 highs until 2013. So that drawdown lasted 5 years. But of course, out of that, we had a nice secular bull market. So, these bear markets really set the stage for bull markets. And now that we've made a full recovery, Are we going to resume the long-term uptrend here? Looks like it. I mean, 2 years of no progress within a structural uptrend. And here we are kind of resuming that. And, you got the positive seasonality into the end of the year. If it doesn't, we kind of talked about that earlier. If you don't see that seasonal strength, that would be a pretty big red flag. So if we do get a correction into the end of the year, or, we do pull back a little, that would be bad for some of those seasonal indicators there. If you want to scroll down to some of those top tweets there, Spence, we got highest RSI reading since September 2020, right there.
In what? Really?
In
Wow.
the 2500. And that's what I was asking our guest about, is basically, do you see that and get concerned, or do you see that as bullish? How do you think about that? And, highest since September 2020, but what happened after September 2020? We had a little bit of a stumble there, but then really took off. So the market can definitely go higher just because it's overbought. And then if you keep scrolling, we got Apple breaking out to all-time highs after 3-4 months, peaked with the broader market in July there, and now we're just starting to get going again.
Apple, by the way, Alfonso mentioned France earlier. Apple now larger than the French stock market.
Yeah, and so if you keep going just a couple more, you had IWM at the VWAP, one more. And today we're gapping above that thing. So pretty resounding breakout there from a key indicator there. That's the VWAP from the peak. So, I mean, that's your average cost basis of people buying since it peaked. So that's a pretty nice breakout today.
Nice. All right, guys, as always, if you want the chart report, it is free. It goes out every single day after the close. You can use the link in the description to sign up. And yeah, Pat does.
And you know what? Can we go through one more? I want to get Steve's take on this one.
Yeah, where?
It's Ross Brown's chart, I think. Yeah, Ross Brown, right here. Steve, I mean, this is a point I know you guys have been making too, but tech on a relative basis. I mean, you haven't even reclaimed those .com bubble highs yet. What do you think about when you see this?
Again, I mean, we talked about this earlier today. I don't know Ross, but I would prefer to look at it with the equal weight ratios.
Oh, okay. But in terms of the fact that, tech hasn't, I mean, have you looked at that? Has it reclaimed it on an equal weight basis?
No.
Oh, okay.
But they look good, right? I think tech keeps leading. It's just different stocks probably driving it.
That's not a chart I want to get short.
No, not at all. I want to talk about these intermarket.
Yep, real quick. What do you got?
Let's do these charts. So, okay. Fed is behind us now. We had the big FOMC to do yesterday. It seems like the market is really picking its direction here. We've talked a lot about these big reactions and awesome moves from risk assets and stocks. Well, that's happening because of what we're seeing from the dollar and rates, right? So throw up the dollar chart. Two really big ugly candles here the last two sessions. We'll see what happens, how we close today. We're down even more today, following through on yesterday's big red stick. Throw up the 5 and 10 year. Let's show that key level, the dual pane.
I'll play the role of JC here real quick. It's all about the dollar.
Right. And it continues to be that way. So look at these big levels and yields too. I think we have to, give just as much weight to interest rates as the dollar, because I think it really sparked this rally off the October lows more than the dollar did. Interest rates back below their 2022 highs. These are huge levels. Fonz, do we have the international yields? Look at this. This has been the best evidence. These European government yields, they've really been leading the U.S. New lows in a big way, new 52-week lows for some of them. I think Spain is close to new 52-week lows. These charts look really ugly now, right? And you're seeing U.S. yields kind of follow to the downside. Now show the big zoomed out 10-year just for some serious context here. 4% is a huge level. I think if we're below 4%, it's sideways at best for interest rates, and that's probably a really good thing for risk assets. Of course, we don't want to see this chart plunge to the downside, right? That would be evidence of maybe something brewing that's not good for risk assets, like a recession. Oh no. But we do, I think, want to see it capped here and below this 4% level. And we could say something similar with the dollar at these prior cycle highs. Did I give you the dollar one? Big zoomed out chart of the dollar here. I'm dropping it to you now. Right. So the dollar's below those, 2016 and pandemic highs, called 103, 103.50. That's very bullish for risk assets. So some really big levels in play, not just over shorter time frames, but when you zoom out on these charts also. So I think 103.50 and Dixie and 4% in the 10-year are some pretty good lines in the sand to kind of dictate, how much further this rally in risk assets is going to go and how fast. Might get some chop at these levels.
Boy, I would love to see Dixie go a little sideways for a little while.
Yeah?
And
Not
interest
lower?
rates. Dixie and interest rates. I'd love to see both of them just kind of go sideways for a little while. Chill out. Let the rest of the market and the rest of the fundamentals just kind of catch up to where we're at so we can get cleaner levels on everything.
Listen, rates have come down a good amount. So I think you're right, Sean. A little cool off there, I think, would be healthy. Down over 1%, 100 basis points in a month and a half now.
I got a bunch of short TLT calls that would really appreciate some sideways action for a little while.
All right.
Let's do some quick recess. I got something real fast. And we'll go. All right, I know I'm like 5 or 6 years late to this party, but over the last couple of nights, we have been watching the movie Coco on Disney Plus. It is fantastic. If you've not seen that movie, it's a Disney Pixar movie. It was just tremendous, man. It was awesome. It was a classic Disney movie, had everything. And like I said, I'm like the last person alive to see this movie, but it was great.
First time I've heard of it.
Coco. Yeah, it's about a kid who goes into the land of the dead. It's a whole. I don't want to spoil it. It's great. It's just a great movie.
He plays guitar and
it's awesome, man. It was a feel good movie, man. It had
is it a cartoon?
It's Pixar, so it's like Toy Story.
Okay. Maybe my family has seen it. I think my son has seen it.
Yeah, awesome.
There's a guy at Pixar. I read somewhere there's a guy at Pixar. He gets paid like $700,000 a year or something to name the movies. And if you think about Pixar movies, they all have the simplest names ever, like Cars or Toy Story, or we could keep going. But man, that guy might have the best job in the world.
Spencer, do you think you're biased as a Disney bag holder?
No, man. No. Okay. The only reason we were even on Disney Plus is because at the moment, due to a comedy of circumstances, we are locked out of our Netflix, Amazon, and HBO accounts.
You're locked out of everything lately. You're locked out.
What happens when you steal it?
Also, I'm now on day 3. I'm on day 3 of being locked out of my Thinkorswim. I was on the phone with Schwab yesterday or 2 days ago for like an hour and more than an hour. And dude, I don't know.
That's not okay. I don't know what's going on, but that's not okay.
I can't even log in. I nothing happens. So
hey, so for my recess, real quick, when you brought me on, the first thing you mentioned was you thought it was snowing behind me. It's not snowing, but you brought up the weather. So I want to talk weather real quick, and I want to highlight and shout out that the sun is finally shining in South Florida. Look at Steve Strazza's lighting situation. Amazing! You look wonderful, old friend.
The brightest office you'll ever see. I went to Home Depot yesterday for some channel checks. I said, give me all the lights.
It looks great. Finally, we can finally see that beautiful face. Looking good, buddy.
Speaking of thanks, Sean. Speaking of Home Depot, nice reversal pattern, taking out those pivot highs. Hey, now.
Okay.
So looking up.
All right. That's what we got. Thanks to all of our guests today. Thanks to Tommy Lackey. Thanks to Alfonso, the chart master. Thanks to Sean. Thanks to Pat as well for hanging out with us all week. Pat, you did great. Fun. We got some good feedback.
Wow, Pat getting up early. Well done, buddy.
Yeah, great job this week, Pat. Chart request live, 1 o'clock.
Chart Request Live with
Oh,
Pat
yeah.
and Steve, 1
That's
o'clock.
right.
Options Jam session with Sean at noon. Before that, right here on the channel, Stock Market TV. Go make some money, everyone. See you guys later.
Pat, go get some sleep.
Bye, everybody.
Yeah. Cheers.
I can't take no loss. I don't even know what it costs.